In today's video, I will show you the 8 secrets about the RSI indicator that I learned over many years of studying the financial markets and technical analysis. I often say that there are many more wrong ways of using technical indicators than right ways, so the trader who wants to make use of them must be extremely careful. This video is an attempt to unveil the most powerful aspects of one of these indicators, but you still need to maintain your caution while using these features. Secret number 1. The origin of divergence. Divergence is not so much of a secret because it has become a very popular trading technique, but my suspicion is that 99% of the traders who use it have no idea why it works, or even why it exists in the first place. Before diving into the reasons why divergence appears in certain technical indicators, let's quickly review the 2 basic types of divergence. This technique is all about comparing the corresponding highs and lows of price action and the RSI indicator. When price action is creating lower lows and the RSI is creating higher lows, we have a situation called bullish reversal divergence, which basically means that price is about to reverse to the upside. When price action is generating higher highs and the RSI is generating lower highs, we have a bearish reversal divergence, which signals that price is about to reverse to the downside. A less understood and yet powerful type of divergence is the continuation divergence, which, as the name suggests, indicates a continuation in the current market movement instead of a reversal. When price is creating higher lows and the RSI is creating lower lows, we have a bullish continuation divergence, which means that price will continue going up. When price action is creating lower highs and the RSI is creating higher highs, we have a bearish continuation divergence, which signals a continuation in a downward movement. The reason divergence occurs is not so obvious. What happens is that price charts are a type of non-stationary time series, meaning that they have a variable mean and variable standard deviation. Another way of understanding this is that price charts oscillate between trending and sideways modes, and there is also quite a lot of variation within these 2 market modes themselves. However, when we look at an indicator like the RSI, we can see that it is a stationary time series, which means constant mean and constant standard deviation. The RSI is reflecting the raw price action in some level, and divergence is an anomaly that appears when a non-stationary time series is transformed into a stationary one. This anomaly turns out to be very useful in some cases, but it comes from a distortion in the original price action. That also explains why other indicators can also show divergence, like the stochastic indicator or the MACD, for example. Divergence has its problems too. These basic types of divergence can be misleading sometimes because price action can keep traveling for quite some time, while the RSI will be displaying a reversal or continuation divergence signal. In other words, even though divergence is a powerful idea, it must never be used by itself because there is no way of predicting when the divergence will work immediately or when it will be delayed. The bottom line here is that divergence is a phenomenon that happens when the raw non-stationary price action is forced to be displayed in a stationary framework like the RSI or any other momentum indicator for that matter. Secret number 2. Smooth momentum reversal. The financial markets are more complicated than what they seem to be, and perhaps one of the most interesting ways of looking at the market is through the lens of fractal geometry. One of the many ideas that spark out of observing the markets through a fractal layer is the idea of smooth momentum reversals. Not all market movements are the same. Some are smooth and others are rough. There is a whole spectrum of market movements between the extremely smooth and the extremely rough. The smooth momentum reversal is when a market movement, or a price vector as I like to call it, can be displayed in the relative strength index by a perfectly smooth line without any breaks. When that momentum line does break, the reversal signal tends to work pretty well, which is something that doesn't always happen when we are dealing with a rough RSI line. A smooth line on the RSI will usually reflect a smooth price vector. There's something about the breakout of a smooth price vector that makes it more reliable in terms of reversibility. This is a subtle technique, but it can work well in any time frame. In the second chart, we can see another example of the smooth momentum reversal. Notice that the breakout simply occurs when the smooth RSI line changes direction, and immediately after that we can see a reversal. Secret number 3. Momentum trend lines. A less common use of the RSI indicator that can also be interesting in certain situations is the application of momentum trend lines, which consists in drawing trend lines in the jittery lines of the indicator and observe when a pattern of successive higher lows or lower highs gets broken. In some specific cases, the breakout of a momentum trend line will spot a reversal in price action before it becomes too obvious. In this chart, we can see an example of a momentum trend line capturing higher lows in the RSI. When the RSI line breaks the momentum trend line to the downside, it signals a reversal, which indeed happened. Notice how the momentum line breakout points to the reversal almost exactly where price turns. It's important that you know that in many situations, this will not work so smoothly like this because of the distortion generated by the RSI. Another use of the momentum trend lines besides the breakout is treating them as simple trend lines. In this chart, we can see that a downward momentum trend line was drawn using the highs marked by the 3 red arrows. When price comes back to the same trend line a fourth time, we're able to spot a price reversal. Notice also that there is very little lag in the signal. The RSI comes back to the trend line at the very peak of the reversal. Secret number 4. Momentum support and resistance. The same principle that allows momentum trend lines to work on the RSI is the principle that allows for momentum support and resistance lines to be applied. Just like regular support and resistance lines on raw price action, we can use such lines in the RSI to spot non-obvious reversal points. In this chart, we can see a few examples of that. Notice that in the RSI, we have a support line highlighted by the green arrows. The important thing to realize here is that if we were just looking at price action, we wouldn't be able to spot this horizontal support. Every time the RSI line meets the horizontal momentum support, price action reverses. An even more pronounced reversal happens using the momentum resistance line highlighted by the red arrows. We would never be able to spot that momentum resistance by simply looking at the raw price action. When the RSI line meets the momentum resistance line a second time, price action reverses immediately after. Secret number 5. Momentum channels. Similarly to momentum trend lines, there is also the possibility of drawing channels on the RSI line to get some interesting results. The momentum channels will sometimes point to non-obvious reversal points in the raw price action. In this chart, we can spot an interesting situation where we have a momentum channel that could have been drawn as soon as the first 3 arrows appeared. Notice how the RSI is displaying a sequence of reversal divergences in the lows and a sequence of continuation divergences in the highs. More importantly, observe how the channel captures the highs and lows that correspond to the reversal points in price action. In the second chart, we can see another example of the momentum channel technique. The 3 green circles represent the highs and lows that were used to draw the momentum channel. The red arrow represents the moment where the RSI line meets the upper boundary of the channel a second time, signaling a reversal. Once again, these non-obvious momentum channels are only possible due to the distortion that happens when a non-stationary time series like raw price action is somehow represented in a stationary framework like the RSI. Secret number 6. Pitchforks in the RSI. Another interesting technique is the application of the Andrews pitchfork on the RSI line. The pitchfork is a very good technique because it has its roots in physics, and it works especially well in stationary markets. In this chart, we can see one of the applications of this technique. The green circles represent the highs and lows in the RSI line that were used to ground the pitchfork. The green arrow represents the moment where the RSI line meets the center line of the pitchfork for the first time. In this case, we can see that the center line of the pitchfork was able to point to a reversal with a good degree of accuracy. You have to keep in mind that these techniques don't work all the time. They only work in specific situations, so you have to be careful and resist the urge of trying to apply them blindly every time you use the RSI. What I mean by that is that these techniques are a little bit more complicated than what they seem to be. They require a certain level of subtlety. If you attempt to apply them blindly, you will be disappointed. In the second chart, we can see another example of the technique. This time we are relying on the outer lines of the pitchfork instead of the center line. Observe how the encounter of the RSI line with the lower line of the upsloping pitchfork points to a bullish reversal in the raw price action. Secret number 7. The smooth RSI. This secret is about changing the source from which the RSI is calculated. Most technical indicators are calculated using the closing prices on raw price action. However, by using some mathematical tricks, we can enhance certain technical indicators like the RSI, which has a jittery and chaotic line. In this chart, you can see two different RSI indicators. The top one has the standard 14-period setting based on closing prices, and the bottom one has the 14-period setting based on the 20-period whole moving average in red. So instead of being calculated using the closing prices, it's calculated using the whole moving average values. Notice how changing the source of calculation makes the RSI line much smoother without adding much lag at all. This can be useful in a variety of ways. For example, it makes it easier to spot divergences without the chaotic motion of the standard RSI line, and in certain situations, the smooth RSI line will yield very clear buy and sell signals, although it's not that simple. Notice that the RSI based on the whole moving average is a stationary reflection of the non-stationary HMA. In that sense, we add the smoothing effect of the whole moving average to the differentiated effect of the RSI framework. Secret number 8. The Divergence Angle. As we already discussed previously, the divergence is one of the most powerful things about the RSI, or any momentum indicator for that matter. However, the divergence hides a number of different secrets. One of these secrets is that the highs and lows that occur when divergence happens between price action and the RSI form a specific angle that can be useful in certain situations. In this chart, we can observe that happening. The green circles represent the RSI lows that point to a reversal divergence. The connection of these two lows form a specific angle. In the origin circle, we can extrapolate a line with the same angle formed by the divergence. In the red arrow, we can see how the extrapolated line captures the next reversal point almost exactly. Interestingly enough, the red arrow also represents a continuation divergence in relation to the origin circle. I hope you learned something new and useful with this video. If you want to learn how to trade with professional techniques, please check out the video courses that I provide. For beginner to intermediate traders, I offer the Fractal Flow series, which is composed by the Fractal Flow strategy, the Market Maker strategy, and a Newtonian trading strategy. Each one of these will teach you a different approach to trading. Each of these strategies work on their own, but they can be combined together also. They work on any market and any time frame that you wish to trade. For intermediate to advanced traders, I offer the Price Action series, which is composed by the heavyweight techniques involving fractal geometry, linear algebra, and very refined contextual market reading to find the most accurate trade entries and exits that are possible to find on a price chart. You can visit my website fractalflowpro.com to see more details about the table of contents of each course and the testimonials from students. If you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Don't forget also to check the other videos in the channel. Thank you very much for watching, and I hope to see you in the next videos. Take care.